The Fed prepares to smash the housing market. Hey, everybody, you're watching Bull, Boom, Bear, Bust. Let's talk about what's happening this week. We have the Fed at the Summer Economic Symposium, and people are going to be listening to what they say. Are they going to promise again to raise rates? 0.75% rate hike is what most people are coming to the conclusion that they're going to promise and actually fulfill. Now, how is that going to affect the housing market? Well, that's where it gets a little bit complicated, a little bit detailed, but we're going to talk about it here, and we're going to talk about the cities that you're likely to see home prices fall the most in the next few months, actually. So let's go ahead and get into it right now. Now, we know the Fed has been raising rates, what's called the Fed funds rate. And if we look back at history over several decades, we see that every time the Fed raises rates, nearly every time, it always induces a recession. If you've been following this channel and other economic news channels, you know that we are officially in a recession now, even though they changed the definition of what a recession is. 2 consecutive quarters of negative GDP growth has put us in an actual recession. Are they going to say that on the news? Probably not. Or if they say it, they're going to put it out there as a question, and they're going to try to debunk it, or they're going to try to point to some other data. But we see what happens when the Fed raises the funds rate. Now, how does that affect mortgage rates, and how does that affect the housing market? Well, mortgage rates are more tied to the 10-year Treasury and the buyer and lender's last resort, the buyer and lender of last resort's action in the bond market. So are they buying mortgage-backed securities? Well, yes, they are still buying them. They have slowed down slightly, but they're still buying them. And that's why we didn't see a spike in mortgage rates along with the increase in the Fed funds rate. It did go up pretty big from 3 to 6%. But if you look at the chart, over the past few months, we actually saw mortgage rates go down, although the Fed wasn't lowering the Fed funds rate. So you could see they're loosely tied to one another. But what the Fed does with in the Treasury markets is the big indicator, or the big lever, so to speak, that moves mortgage rates. Now, what I think is happening is that they will continue to push the housing market down. And I mean that they're not going to let rates drop significantly as far as the mortgage rate. So I expect continued weakness in the housing market. And we do see that the Fed has been ever so slightly unwinding the balance sheet. And the question is, how long will they let this happen? How long will this go before they reverse course and go into another round of QE to infinity and start to drop mortgage rates once again, along with dropping the Fed funds rate? We'll have to see. But right now we do see further weakness as far ahead as we can see. Now let's talk about the areas and the cities where home prices are likely to see the biggest corrections coming up here in the next few months. Next, how quickly is the housing market cooling? We'll take a look at this. Housing market records the sharpest decline in sales in nearly 2 decades. And while real estate sites and entities like Zillow and Redfin are still trying to pump up the housing market, and they're trying to convince people that home prices are not going to fall significantly, we see that reality is setting in because a lot of people are pulling back on their purchases. We're seeing a lot of sales agreement contracts being canceled, buyers backing out. A lot of it's because of fear and what they're finding out and what's happening with the housing market. But a lot of it's just their personal finances. People don't have enough money set aside to have them feel confident enough that they're going to be able to continue to meet these very high mortgage payments that they're going to end up stuck with if they buy a home at these levels. So it's the debt levels, it's confidence, and people being cautious now because they see news like this, headlines like this, that sales are plunging and that prices are starting to weaken and coming down in some areas. Now let's talk about prices next. What cities are going to be the biggest ones with the biggest price drop? So here's a good way to guess or tell. In this case, it wouldn't be a guess. It would be more of an educated guess. But we're going to look at the cities that saw the biggest percentage of listings, homes for sale, the biggest percentage of those that dropped their price. And there's some pretty big ones. And we're going to bring up a chart here. This was actually put out by Axios, but it includes Redfin data. And we told you at the end of last year, at the end of 2021, that Boise, Idaho was going to be one of the first ones to come down. And look what's happening in Boise. Nearly 70% of homes listed for sale had a price cut. 70% price cuts in Boise. Remember, Boise was the go-to city during the health crisis. Of course, people went to lots of other cities, but people wanted to get to a more rural, more smaller city, and Boise saw just a huge run-up over the last couple years. So no surprise that sellers are having to slash their prices the most in Boise. In second place is Denver, Colorado with 58%, Salt Lake City, Utah almost 57%, Tacoma, Washington 55%, Tampa, Florida 52%, Sacramento, California 52%, Indianapolis, Indiana 51%, Phoenix, Arizona over 50%, San Diego, my neck of the woods, about 50%, and finally Portland, Oregon 48%. Now, this doesn't mean that prices are crashing or that prices will crash, but I think we will see continued weakness in the housing market and continued declining home prices. Now, when you look at the numbers year over year, we're still up year over year. This housing market is being very carefully navigated by the powers that be. I don't think they're going to come in and crash the markets, because they would be the obvious cause if they made it that obvious, right? So they're not going to crash the market. They're going to be very slow and delicate about these rate hikes, about the reduction of the balance sheet, about mortgage rates, where they go, how quickly they rise. All right, so this could play out for a long time. And in fact, at this pace, we may not see the bottom for between 2 to 3, maybe even 4 years. It depends on how this is propped up and how carefully and how slowly that they let the air out of this housing bubble. Now, a little bit more into Salt Lake City. That's the city with the third most listings with price reduction. What's happening there with inventory? Well, it's pretty interesting. Let's take a look. In Salt Lake City, that was a city that had over a 200% boost to inventory, and was also amongst the top 5 metro areas with the biggest decline in home sales. All right, so add it together. Inventory doubling, the number of listings with price cuts over 56%, Salt Lake City, Utah. So these would be the cities to keep an eye on if you're looking for buying opportunities. Now, just because prices are coming down in these areas doesn't mean that these are going to be the most affordable areas. If you're just looking to find affordable housing, just the cheapest you could find it, the best places are rural areas in Tennessee, Indiana, Iowa, the breadbasket states, Middle America, in smaller cities, and not any of these coastal cities or these larger cities that we're seeing on the list here. Now, when we look at the housing market with a broad view, we're still not in a buyer's market. So when we look at inventory and overall inventory, how far are we from being a buyer's market? We're still a ways off. Let's take a look at total inventory, not just city by city, but total when you get a snapshot of the United States. Now, one of the rules of thumb in the industry is that a balanced market, where it's not a buyer's market, it's not a seller's market, but it's pretty balanced, would be inventory at 5 or 6 months. So what are we seeing now? Well, we are seeing an increase in overall inventory. The low was about 1.8 months in January of this year, but now we've surged up to 3.3 months, right? So we're only about halfway to what would be considered a balanced market, and that's 5 to 6 months inventory. If we start seeing 6 months, 7 months, 8 months inventory on the market, then that would be heavily leaning towards a buyer's market. So we're still at the beginning stages of this. Please let me know what you think down in the comments. I hope everybody liked this report, this update, and we'll continue to bring you the latest home price news, economic news. Of course, the housing bubble is always at the forefront of a lot of people's minds with the economy and the cost of living. So thanks everybody for watching. Bye for now. Keep stacking. Peace.